I think the really important thing is that there is no way for me to actually tell you, hey, like, this is the most important index or this is the most important indicator. I think that's really, really important for most investors to understand, especially when currently the way we see the growth picture is that we're in an environment where growth is still in a slowdown. Meanwhile, inflation is probably going to stay neutral, and liquidity conditions after a brief kind of seasonal issue have begun to stabilize again. To describe the dynamics a little bit more in detail, you put those two things together, that's how you come up with your picture for liquidity. In today's macro environment, the two things that really, really define those two things is
Aahan Menon is the founder and CEO of Prometheus Research, a systematic macro research firm.
Their data-driven approach combines algorithmic processes with discretionary research to provide real-time economic insights and guide investors towards achieving equity-like returns with lower risk.
And so why is it that sort of the higher interest rates that we've seen so far haven't really translated and really affected the entire economy?
We've had two factors that have actually reduced the effectiveness of that transition. What are those two factors? The first is, it's not that we're headed towards recession based off the most recent week's price action or whatnot. It's just that you've had a repricing of expectations. Now, the question I think ahead for us is, so for us to get to recession from here, what we would have to have is we would have to have a situation where...
Hey guys, welcome back to Less Noise, More Signal. Today I have Aahan on my show, Aahan from Prometheus. Really cool to have you on the show, Aahan.
Hey, great to be here, Pascal. Thanks for having me.
Nice. Yeah. Obviously, I'm always saying this again, but I have so many people that I discover on X, and it pops up somewhere in my timeline, and I keep on seeing posts from some people, and that's why I sort of get interested. And it was the same with you. I've seen you pop up. I've seen people share stuff from Prometheus that you guys put out as well. So I just thought, because I'm sort of interested in what's happening in the broader macro sphere and then also how it ties all back to equities and stuff, I wanted to bring you on. So maybe if you could quickly introduce yourself and then also tell the listeners a few things about the company you work for or with, or I think it's even your own company, Prometheus. Maybe you can go into details there. That would be nice.
Sure. So, as you said, my name is Aahan Menon. I'm the founder and CEO of Prometheus Research. Prometheus is a systematic macro research firm. So we do something relatively unique in the industry where we spend basically all of our time trying to understand what's happening to the economy as it pertains to market. And then we take a quantitative approach to systematizing that understanding to create rules-based portfolios. We create those portfolios for both retail and institutional investors. So our client base spans, everyday investors to RIAs to some of the biggest hedge funds and pension funds in the world. So what we really focus on is spending our time trying to create an understanding of the economy that is actionable, not just today or tomorrow, or not something that's newsworthy or topical, but an understanding that we can use to, invest over many, many cycles.
Okay, I see. Very interesting. Well, maybe just to start off, because you mentioned this, it's also for retail investors. Sort of, how would it work? So like with Prometheus, how do you get to invest with you guys? Is there sort of a EMC or a fund, or how does it work? Especially if you are like a retail investor,
Yeah. So we're a research shop. So we provide model portfolios to investors, and the investors end up replicating themselves. So that's done in different varying formats. So some, for retail investors, it's just, written research reports with systematic portfolios, which they can reconstruct themselves. It's slightly different on the institutional side, where we are able to give them machine-readable formats and things like that. But we're a research shop.
Okay. Now I get it. Yes. So you have the model portfolios and people can actually put them into action. Yeah, that makes a ton of sense. So yeah, well, as you said, so you're trying to, when you do your research, you're trying to make sense of the markets, of the economy and financial markets. And so, yeah, my first question to start off would be, what are you actually looking at? Or maybe even a first question that some people are sometimes not sure of, like, what is driving what? Is it the economy which is driving markets, or is it markets that's driving the economy? Or what's your take there?
Yeah, so I think that's a great question to start with because I think that intellectually it's kind of appealing to separate markets and the economy. But what markets really are is that they're just the balance sheet components of the economy. So the markets are part of the economy. It's not that they're very different. In terms of what's driving what, these things, it's not necessarily that there's a clear relationship that markets clearly drive the economy or the economy, as it's classically defined, drive markets. I think when you're thinking about macroeconomic conditions, what you want to do is you want to paint a comprehensive picture, which basically takes into account both what's happening in the market and what's happening with, traditional economic measures like GDP growth, inflation, and things like that. The way we think you need to aggregate that up to create that comprehensive picture is to track three big concepts. And I'm going to stress the word concepts as opposed to metrics, right? Because there are 100 different ways you can aggregate up metrics to estimate a concept. But what we're really trying to do as macro investors is we're trying to understand what's happening to three very big picture items: growth, inflation, and liquidity. These things are very, very meaningful drivers of what happens to macro market. What are macro markets? Macro markets are stocks, bonds, and commodities. You could include crypto in that as well now, but for our definitional purposes, we look at stocks, bonds, and commodities. And the reason you spend most of your time on these big variables is because they drive almost all of the big cyclical variations in asset prices. And so accounting for those variables and having a tracking process that includes both the markets and the fundamental economic factors, that's really what kind of allows you to navigate economic cycles as an investor more effectively.
Mm-hmm. Okay, I see. Yeah. That's sort of the approach that you're taking. So you're looking at growth, as you said, inflation, and liquidity. And then if we zoom in there in these three sort of buckets or whatever you call their concepts, so like, what is it that you're looking at in more detail, when it comes to growth, when it comes to inflation, and then when it comes to liquidity? And how does that then sort of relate to, whether, as you said, whether you tie to stocks, to bonds, or to commodity markets as well?
Right. So every asset has a slightly different and more nuanced way which each one of these things impacts that, right? I think the easiest one at a high level, and we'll get into the more granular part of this later, but the easy one at a very high level is that liquidity tends to be supportive of almost every asset, though at the margins, it's probably less supportive of bonds relative to other assets. Doesn't mean it. High liquidity means that assets, so commodities, stocks, gold, Bitcoin, short-term instruments, all those things tend to outperform bonds during rising liquidity environments. And so liquidity as a catch-all is generally, supportive of assets. We'll come back to more granular understanding of liquidity maybe later. But just to kind of go through how each one of these things impacts different asset classes. Let's start with growth. Growth at a high level, right? Like what you're really trying to capture is you're trying to capture a combination of what's happening with GDP, so gross domestic product and gross domestic income cycles. You're also trying to understand what's happening to balance sheet, right? So you're trying to understand what's happening to equity markets, bond markets, and things like that, which are basically just the holdings of various economic actors that create GDP and GDP, right? So what you're trying to do when you track growth is you're trying to create a really comprehensive picture that accounts for both, like how much equities are owned by the private sector, how much treasuries are owned by the private sector, are their balance sheets expanding, or is their net worth expanding? And then in terms of the income and spending, you're trying to track what's happening to the income side of the equation, which is GDI, and then you're trying to track what's happening to the spending side of the equation, which is GDP. And what you're trying to do is you're trying to take all of these, in any given month, you have at least 30 plus different meaningful economic data releases just in the United States, and each one of those economic releases has their own sub nuance and whatnot. But what you're trying to do is you're trying to take each one of those economic data releases and you're trying to say, hey, how does this impact the GDP picture? How does it impact the GDI picture? How does it impact the balance sheet picture? And that's what you're trying to do when you track growth. Now, the way that flows to asset markets is different for different asset markets, right? So it's not like growth up, good for stocks, bad for bonds, or whatever. Like it would be nice if it were that easy. But different assets have different biases, right? So let's talk about equities. Equities do care a lot about what is happening to the headline level of growth. But what they care a lot more about is what's likely to happen to earnings, right? And so what matters for equities a lot more is how growth translates into earnings for corporations, and the pace of those earnings for corporations is what determines whether equities are going to be in a bull market or bear market. When it comes to bonds, the most dominant thing when over long periods of time. During short periods of time, you can have a little variation from this template, but the biggest thing that matters for bonds at any point in time is what the expectations are for what the Fed is going to do. And so what determines what the Fed is going to do is just a trade-off between two things and maybe like a small component of a third. But the Fed is has a dual mandate. They're trying to maximize for price stability and full employment. Full employment is a function of growth conditions being good, right? So if economic activity is good, resulting in spending, resulting in output, which is keeping employment elevated, policy rates aren't going to move, right? At the same time, if that spending starts to become really, really fast relative to existing capacity constraint, you start to have more inflationary growth, which causes the Fed to move. And so that's the way growth ends up. There's a different way in terms of how growth flows from the top level to equities and then to bonds. And then when it comes to commodities are actually a much smaller section of the economy relative to stocks and bonds in terms of market capitalization. Commodity demand mostly comes, I mean, this is fairly obvious and kind of definitional, but commodity demand comes from goods demand, right? Which is, so when somebody is buying something on the internet or, using Facebook or using, the service-based industries that we have today, that doesn't meaningfully move commodity demand. So what meaningfully moves commodity demand is the demand of raw producers and consumers, which are businesses, in the economy, which is also a subset of growth. So you have this high-level concept of growth, but the way it flows through to each asset class is slightly different and more nuanced.
Mm-hmm. Yes, exactly. Yeah, that's well explained, obviously. Exactly. That's like each asset class is sort of affected differently and then also responds differently. But and I also do want to talk about the interconnectedness of these sort of growth, inflation, liquidity and stuff, because there is also some of the key questions that I have. But maybe before I want to ask this, I would like to ask you, sort of, how do you go about assessing growth and then also inflation and liquidity? Sort of what is the signal indicators that you're looking at? And maybe is there also some stuff that you just sort of say, okay, this is noise, and maybe some people are focusing on this in order to calculate inflation, I'd say, or it's probably more nuanced with liquidity, because liquidity, inflation indicators are more straightforward. But what is it that you're looking at concrete in terms of indicators? This show is brought to you by NewHedge. In a market driven by complexity, insight is everything. NewHedge is a dedicated Bitcoin analytics and intelligence platform delivering cutting-edge analysis, on-chain metrics, and real-time market data. With 200 plus proprietary indicators, live derivatives data, and adoption metrics, NewHedge provides the depth and precision that serious market participants demand. Backed by some of Bitcoin's most prolific investors, NewHedge connects traditional finance with Bitcoin's evolving landscape. Gain your data edge today. Sign up for free now at newhedge.io and get 50% off your advanced subscription with the code SIGNAL.
Yeah. So, when it comes to indicators, right, you basically have, let's say, about 4 to 5 major data reports that meaningfully shift growth, tracking of GDP. So if we define what our growth indicator is, of, hey, like we want to understand if I find GDP growth. There are maybe, a few releases every month that very, very meaningfully move the picture. So what is those releases? Those releases are things like the employment data, personal consumption expenditures data, retail sales, industrial production, some amounts of PMIs, though much less so than they used to be, and total vehicle sales and import and export data. Between those things, you basically get the bulk of all the muscle movements, right? Like those are the major items that kind of define where you are in the cycle. And then of course there's housing data, which I missed, which is very important as well. And ancillary to all of these things, you also have things like new home sales, you have manufacturing and trade sales, you have other slightly less important data series. But I think the really important thing is that there is no way for me to actually tell you, hey, like this is the most important index or this is the most important indicator. I think that's really, really important for most investors to understand, especially when you're, starting a macro journey, or you're just trying to figure out like, hey, how do I actually leverage all of these indicators and all this data? The thing is, there is an inherent, like we always want to find the best thing, right? Like we always want to find the best indicator that will tell us that tomorrow is going to be a recession, and then we can, short stocks, long bonds, like do all this. But what we found, and the way we do things is we try to construct some data series we have going back to the 1930s. We construct historical, we construct historical estimates for a really, really wide range of data. And what you'll find is that, okay, like maybe over the last cycle, so let's say the last cycle, there are only 2 or 3 recessions. So since like 2000, retail sales has been an amazing indicator. Let's say that, okay? What happens is if you go back into history and say, hey, like, what if I traded based off retail sales in the 40s and the 50s and 60s? What you'll find is that indicator might not have been as good as we thought it was recently. And so what you have to do is you have to say, I need to create a picture that combines all the indicators, right? And that gives me my best chance of success, because there might be times where, retail sales are good. There might be times where housing stocks are good. There might be times where, personal consumption is good. It varies by every cycle. And so like what we think matters a lot more is, rather than handpicking this indicator outperforming that indicator, is to be able to add up all the indicators and say, hey, the combined picture of, these 20 indicators I found is telling me that growth is back. That type of understanding has a way higher probability of predicting the future better than, just picking the best one. It's kind of like diversifying, your portfolio. It's an essential part of being successful over long periods of time.
Yeah, exactly. Because sort of what we're telling me is sort of, obviously the economy or the market as such might be different from let's say a few decades ago, because like a very easy example would be you have an economy which was really like driven by manufacturing and like goods producing and stuff, and then you're looking at these sort of indicators, but maybe today this same economy is really driven by services, and it's really like a services economy. So then it might not be the best thing to look at these sort of indicators, which are sort of outdated, as I understand, But then what you're also telling me, like trying to pick the right indicators to look at, is sort of like saying like a stock picking. You're trying to pick the exact right stocks, which maybe from experience we also know it's kind of hard if you're a really active stock picker and to be consistently always beating the market. So it's sort of the same thing, and that's why you're telling me, okay, some sort of aggregation and then some sort of average might be better in the end and just more accurate, because there's so many moving parts and indicators that might be changing all the time. So that's why it's so hard. Is that sort of a fair summary?
Well, that's 100% right. And actually, like, you touched on something that's very relevant. So, um, over the last, let's say, few years, you basically had a very material deterioration in the manufacturing sector. And that's caused very popular leading indicators to decline. So there's the one which, the majority of people that are not constructing their own private leading indicators uses something called the Conference Board Leading Economic Index, which is pretty popular on the street. I'm sure that a lot of your listeners know about it. That index was, the original construction finds its way back in, I think, the 60s. That's when the indicator was originally constructed. It was constructed by the Conference Board, which was associated with the NDR, which actually helped create recession definitions and whatnot. But basically, the way that indicator was constructed was that the core principle was that the manufacturing economy was the best leading indicator of what's going to happen to activity. And at that time, that was a really, really good and timely insight, right? But what we've had over the last few decades, particularly with China entering the WTO, is that we've had an offshoring of most manufacturing in the United States. And so you've had a situation where manufacturing used to account for more than 20% of US economic activity. And now it accounts for sub 10. And so as a result, even if manufacturing does really well or really poorly, the amount that actually flows through to total activity is always very small, right? And I think that that's particularly important because manufacturing has been in a rolling recession for 3 years, right? And if we were in the same type of economy we were in maybe the 70s, right? You would have had a recession by definition. But the economy has changed, the weights have changed. And so if you glommed in and zoomed in on this one section that looked really, really great for a long period of time, you would have ended up offsides even today.
Yes. Okay. I see. Yeah. Yeah. That's so interesting. And I mean, from what I'm understanding, this is really the part that we've now discussed and that you tried to explain was sort of the growth concept, like with these indicators as you just try to show. And then I understand, yeah, this is quite tough already to pick the right indicators there. That's why you want to maybe go for some sort of average. When it comes to the inflation concept, I feel like it's more straightforward because like we have these, government, published numbers, and so everyone is looking at them, even though nowadays there's like other indicators like trueflation and like these sort of real-time inflation metrics, which might be floating around. But then the third one I'd like to ask you about, the liquidity component that you mentioned, because I have a feeling this was also something that's grown in relevance in terms of how it's also perceived, by market participants. I guess like maybe I wasn't around, but 30 to 40 years ago, maybe not as many people were looking at sort of this concept, the liquidity concept. So maybe if you could shed some light there, what are the things that you're looking at there? Because obviously, yeah, you can look at global liquidity, you can look at central bank liquidity, you can look at M2, but then you can also, like as other people, Michael Howell that we had on the show already as well, he's sort of going for a much more extended version of liquidity where he's looking at private balance sheet capacity and all these type of things. Yeah, what are you looking at? Can you tell us something there as well?
Yeah, of course. I think, just to add on to what you were talking about, I think the preeminence of liquidity as a concept really found its roots around the GFC. So if you wind back to periods prior to the GFC, the most dominant driver of what we call liquidity today was basically just policy rate, right? And so what would happen is an easing or tightening of policy rates would create better financial conditions through the financial system, and that would spur lending and borrowing in the economy. But around the GFC, we basically had two very significant developments, which was basically that commercial paper markets basically imploded. And at the same time, we also hit the zero lower bound in terms of policy rates. So Fed had to come in and begin to institute quantitative monetary policy, where they began to do QE and QT and the related. And so as a result, what you started to have is a situation where what the Fed did with its balance sheet started to matter a lot. So basically, what happened during the financial crisis was a transfer of the liquidity creation mechanism as a handoff from what that was basically almost entirely dominated by the private sector. So prior to the financial crisis, you definitely had a lot of repo activity, but you also had a lot of paper activity which was undertaken by banks. That commercial paper activity basically halved during the financial crisis, and as a result, you actually had all of that capital move into bank reserves. And those reserves actually became definitionally much more important to understand what liquidity conditions are. Now, just to take a step back, I know I kind of zoomed in for a second. Take a step back and kind of clarify. Liquidity, people use a lot of varying definitions for what liquidity is, right? And sometimes it's a catch-all to just describe, I couldn't figure out what growth and inflation we're doing, so liquid. But the basic definition is what you're trying to understand is how much cash and balance sheet capacity is there in the system. And so, to clarify further, you can buy assets and invest in projects based on two things. Either you have a large amount of existing cash, or you have a large amount of balance sheet capacity. What is balance sheet capacity? Balance sheet capacity is your ability to leverage up, right? And so when financial conditions are easy, so, policy rates are low, spreads are tight, and economic conditions are generally good, credit is easily extended to people looking for it. And that's an integral part of liquidity. So there are two components that you're really looking for when you're trying to assess what's happening to liquidity. You're trying to understand, hey, is there a lot of cash in the system, in the financial system? And then you're also trying to see, hey, do financial system participants have the ability to leverage up their balance sheets a lot? You put those two things together, that's how you come up with your picture for liquidity. In today's macro environment, the two things that really, really define those two things is the amount of reserves in the financial system plus the amount of repo activity that you have. Commercial paper has become a much smaller component of liquidity today, though you do still have to account for it. Now, if you account for those two things, you basically have a really good understanding of whether financial system liquidity conditions are good or bad.
Mm-hmm. Okay, I see. And what would be the concrete metrics then that you would look at? Is there sort of a metric out there that you can look at, or is this sort of, you really have to get down into the nitty gritty and do your research and sort of aggregate all the data, with private, entities and stuff, or how would that work?
There is no readily available liquidity index that you could possibly just find on Fred, for example. You'd have to go into the data, add up various different measures. I think some simple measures to add up is to go and look at total repo on dealer balance sheets, then to go and look at reserve balances, go and look at the amount of commercial paper outstanding. And those things basically get you the quantitative definitions, right? Like the total amount of money size definitions. But what you also need to do is you need to go and look at various measures of the bond market, NVS market, credit spreads, things like that. So you have to do a lot of individual work. There's no readily available way to track it.
Mm-hmm. Yeah, it obviously makes a lot of sense. Otherwise, everyone would just be sort of a star investor, and that's probably where the alpha comes in. If you're able to aggregate these data sets correctly. But I mean, I want to bring in the layman perspective here as well. Sort of like somebody who's listening to this, and then he's like, okay, yeah, growth, inflation, liquidity, all these broader concepts make sense to me. But then they're sort of, as I already hinted at, they're sort of interconnected, and sometimes I would say, from a layman's perspective, in some sort of, how would I say, a counterintuitive way, because like you go about and you see growth is doing well in the economy, and then obviously with growth doing well, the economy is doing well, but then also this might sort of spur inflation, and then with inflation going up, yeah, it might be that liquidity will go down at some point because the Fed will have to raise interest rates, and so how do you go about sort of making sense of these sort of interconnectedness, because like all these indicators are sort of, or not indicators, but all these, the things that are driving obviously everything, it's so complex, and it's also reflexive. So as an investor, you sort of also have to be forward looking, I guess, as the market is itself, so I hope you know what I'm trying to get at here with this question.
Yeah, I think that when you're looking at all of these different variables, you're going to have a lot of overlap. Like that is it, because at the end of the day, when you're talking about a macroeconomy, these things that you're describing, they are, when put together, the definition of what the macroeconomy is, right? With a particular focus on markets, of course, but you put together growth, inflation, and liquidity, you basically have a comprehensive understanding of the economy. And now I think the main thing that you actually want, so there will be times where these three things basically do different function, So maybe liquidity is increasing during a growth slowdown, and you have high inflation. These things can happen often. But what you really often will find is that when you have really, really extreme outcomes, you'll actually have all of these things move in sync. So let me describe an example like that. During the onset of a recession, growth and growth expectations, credit, borrowing, all those things start to fall. When growth falls, let's remember, growth is a nominal concept to begin with, right? And then once we account for, hey, how much output do we have, or how much inflation we have, then we basically get to real growth and inflation. But as nominal growth falls, the potential for inflation automatically falls by itself, right? Like if nominal GDP is 2, like unless real GDP is negative, you're going to have inflation less than 2. And so those two things are inextricably linked. Now, as nominal GDP falls, you also have the potential for inflation falling. At the same time, and a really important part of liquidity, as I've just described, is what's happening to repo and what's happening to private markets and the ability of, private sector individuals to lever up. And so as nominal growth is falling, the ability to extend your balance sheet is also falling. And I think the really important thing is that when all of these things line up, it's when you get the really, really big macro boost. Like the 2008s of the world are really when all of these cycles come into sync. They're not always in sync, right? That's not necessarily true. But when you have all of these things come into sync, you get the clearest, most comprehensive signal that, hey, I need to make certain asset allocation decisions. I need to rotate out of my stocks. I need to go into my bonds. I need to, maybe prefer stocks over commodities. All these different types of asset allocation decisions you make happen when you have these big swings in the economy, which reverberate through these three different dimensions.
Mm-hmm. Yeah, that sort of means for me as an investor, you're always, as I said, also forward looking, always trying to anticipate sort of the economy and the market's next move as well, or maybe the market participants' next move. As I said, because you described it well, like if you have growth and nominal growth, and obviously then this might lead to some sort of inflation down the road, and then that's why obviously, if there's a lot of growth, this also means there's a lot of private balance sheet capacity for people to lever up. But this at some point could sort of hit the point where inflation gets out of hand, and then the central bank will sort of be obliged to act, and sort of try to bring short-term interest rates down. And then again, that's maybe the sort of the pivotal point that you want to anticipate as an investor, to maybe then take some chips off the table, right? It's always that game that you sort of have to. So it sounds so easy, but you have to be one step ahead, or even maybe 2 steps ahead, right, of what's going to happen. Yeah,
I absolutely think that I mean, and that's really what makes you able, as a everyday investor, or even an institutional investor, like what you're really trying to do is you're trying to take all of these big picture kind of ideas, and you're trying to say, hey, like, how are they going to evolve in unison, and are they going to create like a really big opportunity to, either avoid a drawdown or to profit on the short side or long side? That's really what you're trying to do as an investor.
Hmm. Yes, exactly. So maybe if we come to today's economy and what's happening in the market right now, so and we tie all of these concepts that we now discussed to today's markets, what comes to mind, in terms of growth, inflation, and liquidity? Obviously, I think there's a lot of people who are arguing that growth is still doing well. Then you have other people who are saying, well, we're not just right now seeing some sort of growth scare. Others are even calling for a recession again. Then at the same time, we had these inflation numbers a few weeks back, where it seemed to be, or it seemed the case that inflation is still sticky. And others are like, no, deflation is around the corner. So again, you have all these conflicting views. And then obviously there's also liquidity in terms of what's happening with the debt ceiling and everything. So what is your take now if you sort of analyze everything in terms of the concepts that you were describing as for today's market environment?
So I'll give you the view that we actually sent out to clients just yesterday, which is, we take about cumulatively about 500 different indicators, and we add them up to create the picture for each one of these things, right? And just to give you the synopsis, currently, the way we see the growth picture is that we're in an environment where growth is still in a slowdown, right? Meanwhile, inflation is probably going to stay neutral, and liquidity conditions, after a brief kind of seasonal issue, have begun to stabilize again. Now, to describe the dynamics a little bit more in detail, what started to happen with the GDP picture is that you've had a combination of a couple of things. So there's a little bit of noise with GDP today, particularly because of what's happening with export and import activity. You had basically a bunch of tariff front running, which has basically caused imports to pop. Imports are a drag on GDP, and as a result, you've actually had low stated GDP. But if you look at the domestic picture, which is just consumption, investment, and government spending, that picture is a lot more robust than the Atlanta Fed GDP nowcast kind of indicates today. So there is an evolving bifurcation in the economy, though. The consumer is spending very, very strongly. Like if you go across, so we talked about 16 subsectors. So you have 16 major sectors in personal consumption expenditures, which is 70% of the economy. And within that, we can distribute that to about 90 some indices as well. But at the high level, 100% of personal consumption expenditures areas are expanding over the last year, right? That type of spending is totally inconsistent with any recession we've ever seen. Even if you account for the fact that consumption doesn't meaningfully decline during a recession, you still have weakening in the breadth. Because you still have items like motor vehicle sales, durable goods sales, furniture and appliance sales, like all of those types of things in personal consumption. And those things do decline during the recession. But today, none of those areas are declining, right? And so that's one side of the economy. On the other side of the economy, what we have started to see is that investment spending has begun to decline. Particularly the area where investment spending has begun to decline, which is really meaningful, is housing. So residential investment has begun to slow quite meaningfully. Other areas of investment are equipment investment, and equipment investment has been in a downturn consistent with what's been happening with the industrial economy, like we talked about, for a couple of years now. But the thing that has the most impact on investment conditions is residential investment, which has begun slow. And so when you put those two things together, yes, we are definitely in what we think is a slowing economy. But for that to turn into a recession, you have to have a situation where some sector experiences such bad outcomes that they fire a bunch of employees, right? And that turns into a drag into total activity. So the thing about layoffs is that, if, you or I have companies, when we lay off our workers, it's because, we're trying to help our bottom line, right? Like that's why we do it as individual, actors in the economy. But when you do it in the macroeconomy, what you're essentially doing is you're taking out somebody who did production and also who does spending at the same time. And that's what creates a reflexive loop, which is what a recession is. So for us to get to recession from here, what we would have to have is we would have to have a situation where most likely today is going to be construction. Construction would have to lay off a significant amount of employees, right? But that's just not what we're seeing. Today, in fact, construction is one of the top 5 growing sectors in terms of employment because there's a huge amount of backlogs that the construction sector is actually still working through. And so until you see a meaningful deterioration in construction employment, you can't really have a recessionary circumstance, even though investment is weak, given where consumption spending is at right now. So, that's kind of the growth picture.
Maybe if I can quickly ask a question here, because that's great context, because I feel like a lot of people are astounded by the fact, that today's economy is still doing that well despite the higher interest rate environment that we're in, And you now told me sort of, okay, we see some decline in the residential investment sphere, and that may be exactly due to higher interest rates, that are sort of circling through there or translating into this. But then, as you said, the consumer spending and everything still seems to be going well. And so why is it that sort of the higher interest rates that we've seen so far haven't really translated and really affected the entire economy? Or are we now sort of at a juncture where this is starting to happen and it just didn't happen before? Or is there something else going on altogether?
Yeah, I think that's a great question. We've done obviously we've done a lot of work on this particular topic. So I'll start by saying policy tightening doesn't impact every part of the economy the same way. So it doesn't impact, the raising of interest rates impacts the construction sector and transportation sector way more than it impacts the tech sector. Because the tech sector is not as debt intensive and even the consumption is not as debt intensive and things like that. And so policy tightening is having some effects in some places. But the question is, where are the most people employed today, right? And is the tightening flowing through to those sectors? So today we have a highly services dominated economy with a huge portion of employment actually in the services sector, which is not super debt intensive, right? As a result, okay, you may have raised interest rates a lot, but that's impacting much more the goods, industrial, real estate, and transport economy than it is the services economy. So how do rates actually get into the economy, right? That's an important thing to show. Rates get into the economy by by making businesses reticent to take on new debt, right? And then the second part is as they refinance their existing debt, the increase in policy rates flows through to their interest cost, which relative to their income growth can become a drag, right? Now, that's the way interest rate policy has flowed through to the economy for decades. Now, we've had 2 factors that have actually reduced the effectiveness of that transmission. What are those 2 factors? The first is the factor that we've discussed, that the industrial, real estate, and transport and all these very cyclically sensitive, highly leverage intensive businesses have become less of a component of activity and less of a component of employment over the course of the decade, right? And as a result, you tend to have just generally more interest rate insensitive. That's one high level. The second component is a relatively unique and probably underappreciated factor, which is while the private sector does pay interest rate, so they do as policy rates rise, they pay their interest rates on their debt rise. They also receive something which is called an interest benefit, right? An interest benefit. What is that interest benefit? Anybody that owns a government security gets interest income on those securities. So as you raise policy rates, it begins to increase the amount of interest income. So Now, what that relationship depends on, it depends on the ratio of government assets relative to private sector assets. And in the post-financial crisis world, government assets have almost doubled. They're about 35% of total private sector non-financial sector assets. So as a result, you basically have a huge amount of government assets on private sector balance sheets today, which as policy rates rise, actually create more income. And that neutralizes the tightening of policy. Now, that doesn't mean that the construction sector is getting a huge benefit. That's not what it is. But what it does is it means that in the aggregate, the tightening of policy isn't just having as much effect. The construction sector is having a really tough time, but the tech sector is having an amazing time because they have huge amounts of cash pools, which are invested in money market funds, which earn the short-term interest rate, and they don't have large amounts of debt. As a result, the aggregate economy, and that's what really matters when it comes to the recession, matters to the Fed and all those things, the aggregate economy isn't experiencing the amount of tightening that was consistent with this type of hiking cycle that we would have seen in the past.
Mm-hmm. That's actually a great explanation. Yeah, because I think I heard Lynn Alden explain it sort of in a similar way as you said, just because high interest rates, which obviously then, are filtering through into the economy are sort of stimulative, because a lot of people are holding government bonds and government debt and they pay quite a decent amount of interest. And that's sort of, stimulative to the economy. So that certainly makes sense to me. But yes, yeah.
Just I think one thing that's really important to note though is that isn't always true, right? Like it doesn't mean that from now on, whenever we do interest rate hikes, it's going to be stimulative. What that is conditional upon is conditional upon how many government securities do we have on the private sector balance sheet. So if tomorrow, if we basically, rebalanced our balance sheet, we didn't have any debt, government debt in the books at all, the tightening would flow through just as it did earlier. But that process is going to take a really long amount of time. So it's not a very bad bet to say that, hey, like policy is not going to be as effective as it was. Policy is not ineffective. It's not as effective because of the changing dynamics. So we could very well have a situation where you have tightened monetary policy. It might not impact the whole economy. But if you make conditions bad enough for one particular sector, because of the reflexive loop that we described with employment, it could still very well flow through. It's just that it's not as effective as it used to be.
Yes, exactly. No, that's a great point to add for sure. And I mean, these changes always happen at the margin, obviously, but then that's exactly what you want to have on your radar. And I don't know, maybe just one thought that comes to mind, because it was recently discussed, and I'm sort of not an expert on this either, but with quantitative tightening, we saw some Fed members say that this might be, that they want to slow it down, and then obviously this could sort of be also then have the effect of, again, more government securities moving from private actor balance sheets onto maybe more, I don't know, state sort of balance sheets. And then that would also at the margin kind of slow down these effects again, if that were to happen, just as you said, it's always quite complex, but certainly something you have to have on your radar as well. But I mean, growth, that's something we discussed, but then, in terms of inflation, the second concept, just how are you looking at this? Because again, we have tariffs, which some believe could still be sort of inflationary, then we have some other things. It seems to be sticky. Then we have Doge, just all these buzzwords where people then again think, okay, this is sort of rather deflationary, but how are you thinking about inflation and where it's going to go over the next few weeks or months even?
Okay. So let's up the table with two perspectives. So let's start with there are basically a high level macro perspective and then the item by item perspective. At a very high level, inflation is just going to be conditional upon how much nominal spending you have in the economy. So as long as you have a relatively tight labor market and output and production expanding, you're going to have a more inflationary environment. Further, if you have an environment where nominal spending is significantly above the existing interest burdens, which basically means that debt service, it's easy to pay debt service, which we basically have today. Interest burdens are low and nominal spending is high. It's still easy for the economy in aggregate, not every company. It's easy for the economy in aggregate to continue leveraging up, which is a highly inflationary phenomenon. So the potential for inflation is set by those factors, right? So it's what's happening to production, what's happening to the labor market, and what's happening in nominal spending relative to interest burden. Getting a line item lower, right? So just to skip back for a second. Those conditions are largely consistent with inflationary pressures persisting. The labor market's still relatively tight. Nominal spending is still elevated relative to interest burdens. Production has definitely begun to decline, which is resulting in the goods deflation and disinflation we've seen recently. But the comprehensive add up of those variables, we're still in an inflationary period, which is what we're seeing across inflation measures. We're just not getting back to the Fed's target. Is it an end of the world inflation? No, we're 2.7-ish%. Take your indicator. It's above the Fed's target, but it's not a stagflation. It's not a hyperinflation. And unless nominal GDP just skyrockets for some reason, which it doesn't look like it's going to, given the fact that people are worried about recession and whatnot, you just can't have a very serious inflationary burst. Getting into how does that actually translate into a line by line item kind of perspective. When it comes to inflation, there are basically 4 big goods components that determine the majority of inflation, and then the services components follow those goods components, right? It's because the way I would think about it is that goods contracts, the pricing of goods happens on a very frequent basis, right? People are buying metal and steel and agricultural products every single day. As a result, they're repriced every day. So commodity prices are volatile. They move on a very near-term basis. Services contracts, people are employed for really long periods of time. They don't, churn their jobs that often and whatnot. As a result, the inflation always starts on the goods side and then flows through to the services side of the economy over time. Now, there are basically 4 big components of goods inflation that matter, that end up reverberating through the whole system. What are those 4 parts? Food, energy, transport, housing. If you can account for these 4 things, you can basically account for 90% of the variance in inflation at any given point in time. So you really want to spend most of your time focusing on either. The food and energy components are basically just consistent with what happens to energy prices at any given time. So, and energy and commodity prices broadly. So if you have a broad-based tracking of agricultural and commodity prices, you will basically have a good picture of what's happening to food and energy components. Today, we've actually had a pretty rapid increase in commodity prices across the board, which is supportive of inflation, rising modestly over the next few, let's say, quarters or so. Nothing very big, but something to definitely note, particularly on the energy side. The other 2 components are transport and housing. Now, the transportation component is one which is extremely unique because essentially what we've had in the US is in the post-COVID era, we've had one of the biggest rundowns of transportation inventories ever. If we go and look at automobile dealer inventories, what we see is that we have one of the most depressed level of inventories relative to sales ever, and that's after a considerable amount of improvement. So what automobile dealers across the United States in aggregate are trying to do is they're trying to basically restock inventory, right? But they just are not being able to do it because production actually can't keep up with it. And so as a result, you have this persistent and pervasive kind of like pressure on inflation. So we've been talking about this for almost 2 years now, right? Where what we've been saying is that, look, everyone understands housing, and that we'll get to the housing component in a sec. Everyone understands housing, but what is really the thing that is going to be a thorn in the Fed side is going to be what's happening with transport, because you have this underlying demand. Now, in addition to that, you also have tariffs on Mexico and China and Canada, right? These places account for a huge amount of automobile imports, which actually are a very, very large amount of total sales. I don't want to butcher the number, so I'm just going to go with very large amount because I can't remember the precise number. But essentially, if you do actually have very large tariffs on all imports passed on all of these areas, that's going to flow through the automobile prices, which are going to be passed on to consumers, and you will likely have higher inflation in these areas. And so that's one area where we're relatively more concerned about inflationary pressures, which is the transportation sector. Finally, housing, right? Housing prices, it's been done to that. Everyone talks about it. Like the shelter calculation in CPI is supposed to be lagging and whatnot. I, in fact, think that it's a relatively good methodology. You don't want to have real-time house prices. Like the idea in shelter CPI is not to have what is the most recent price that people are paying. What you want to have is you want to have a smooth number which reflects the fact that people lock in housing contracts for long periods of time. And so that number, given where housing activity is and given where timely measures of housing activity and housing prices are, is more likely to fall. And if that number falls, consistent with, what our expectations are, you will have a very, very meaningful kind of slowing of inflation. But that meaningful slowing of inflation is something that a lot of people expect. And so what we think is the thing that we're kind of really focused on is, hey, like, is transportation going to be something that's going to, really kind of affect the Fed's objectives over here? Putting all those together, the macro context and these individual kind of pieces, we basically think that we're in an environment where inflation is just, it's not going to be terrible. It's just not going to be consistent with what the Fed wants either, which is going to be tough for the bond.
Okay, which is sort of, still some uncertainty that's floating around or sort of, but I think before I want to ask you, on how you're thinking that, shared with us on growth and inflation sort of informs and influences the concrete steps that you're taking in terms of portfolio allocation. I want to come to this one last thing about liquidity, where you mentioned, liquidity is sort of stabilizing. That's also something that I heard you say before. So can you maybe elaborate there as well what you meant?
So a big part, so the most volatile component, I would say, of liquidity conditions is what's happening to private sector repo, right? And private sector repo conditions vary a lot seasonally because banks have various reporting requirements and they have to increase or decrease the amount of reserves they have on hand and whatnot. And as a result, what you tend to have is these seasonal periods where repo markets can experience stress. We experience a pretty serious kind of one of those seasonal, periods during December. And what that does is it basically leads to a pullback in the ability. So what do people buy with repo, right? People buy equities, people buy bonds, people buy credit. All of these things are levered. These instruments are levered using repo. And so we did have a seasonal period of weakness in repo consistent with basically every year that we can track for. But that seasonality has kind of begun to fade. Now, the question is, are we going to continue to see that weak? I would say that, like, if you're actually looking at where does the money for repo come from, right? I think that you need to have, and this speaks to the circularity of things that we talked about earlier. A big part of the money for repo actually just comes from money market funds. They're probably one of the biggest investors in repo market. And the money for money market funds just comes from the economy. So if that's from households and corporate. And so if you have good economic conditions, modestly elevated or consistent or rather stable savings rates, and modest or elevated profits, that money actually flows into repo. So today, when we look at the current profit picture, we don't see an environment where earnings are deteriorating and turning dramatically negative. It's not like, the personal savings rate is also, just plummeting lower given the fact that it's extremely low. And so as a result, these private sector flows into money market funds, which potentiate repo, just aren't, in a very negative spot right now. And so when you take that into account and also take into account the fact that we've had a stabilization of bond markets, and bond markets are a really, really important part of repo because essentially the collateral, right? So what is the dominant source of collateral in repo market? it's bonds. So when you enter a repo transaction and you want to lever up, what do you give people? You give people treasuries across the yield curve, right? So T-bills are probably the best. If you have a bond on hand, that's fantastic. If you have a 5-year note, that's also great. But treasury securities, that's the primary collateral for repo. And what you've had, especially with bond market rallying, and you've had a cutting cycle ongoing right now, you've had a stabilization in bond vol, which actually reduces the haircuts required for repo. And so as a result, you basically have a situation where, okay, like the economic flows that support repo activity, not terrible. The seasonal period of repo that has, created stress in the repo markets is kind of, is behind us. And you also have a stabilization of bond vol recently. And so now you basically have a situation where private sector liquidity conditions have stabilized once again. And now the question is, whether you're going to have a deterioration in reserve balances or not. And that's an open question. I don't really have an answer for you on that particular subject today. But at this particular junction, you basically just have this improvement in private sector repo and private sector liquidity condition, which is resulting in that stabilization.
Okay, I see. Interesting. Yeah, that's some great thoughts here. I mean, if I want to summarize it all, and so kind of you told me growth, okay, it's still doing okay-ish, and it depends on where you look, but nothing too frightening. Then in terms of inflation, again, there's maybe some problem to really getting back to the 2% level, but nothing like really hyperinflation style. So that's okay, also under control. And in terms of liquidity, the situation seems to be stabilizing as well, especially since we had these seasonality effects that sort of seem to wane off. So what does this mean then? And I'm asking because like markets in the last few days and weeks, they have sort of struggled, and also equity markets. And why has this been the case? Is it because of the growth scare that everyone is talking about? Is it just because it's a sort of hiccup from stomaching all the uncertainty that Trump created, or what is it? Or is there something deeper, that sort of causes or has caused this?
I think a little bit of both. So I think that when you're looking at markets, what matters is not the absolute level of growth. It doesn't matter whether growth is positive or negative. Like that particular thing doesn't matter right now. What matters is what the expectations of growth were and how those expectations change. Same thing for inflation, same thing to a certain extent for liquidity. Liquidity you can't really price effectively, but that when it comes to growth and inflation, you can price them relatively effectively. So what we really had today is we basically had a repricing of markets, which to us doesn't look consistent necessarily with the ongoing pace of economic data. Like economic data has the only meaningful thing that's happened is that you've had a bad trade balance resulting in GDP knockoffs falling. But beyond that, you've had maybe one bad retail sales print in January, which is 1 month of bad data relative to, a year of good data behind that. And so you have had some negative data recently, but nothing consistent with the sell-off that we've seen over the last, 3 or 4 weeks. What we think is happening is that you have a huge amount of uncertainty now being priced into markets, driven by, a combination of tariffs and Doge and constant headlines and whatnot. And so basically you entered this year with equity markets in particular just expecting tremendous growth outcomes, like 20% year over year EPS, things like that. And so what you've had over the last few weeks is basically markets saying, hey, we don't know what's going to happen with all of this policy change. Is the deficit going to get cut in half? That's not likely at all. But, we don't know what the effects of all these policy changes at the same time are going to be. And investors are pulling back on their risk exposure. And at the same time, you basically had a situation where that flow has been rebalanced into bonds. Now, the thing that I think is really important to recognize is that it's not that growth outcomes in themselves are bad. It's not that we're headed towards recession based off the most recent week's price action or whatnot. It's just that you've had a repricing of expectations. Now, the question I think ahead for us is markets in themselves can be extremely reflexive, right? So what happens is if you have a large enough move in markets, it can actually begin to impact the economy through wealth effects and whatnot. And so if we continue to have investors pull back because of uncertainty, over time, that actually bleeds through to the economy, which creates kind of a self-reinforcing downwards cycle. Now, I think the main thing to recognize is that should you be more cautious in that type of environment? We think so. Like, we think you should be more cautious in this type of environment. But does that mean that we're headed into a big recessionary downturn? We don't think that that's true.
Hmm. Okay. Yes. So as I understand you, like it's just sort of a slight recalibration that's been happening, and some people have been, yeah, getting more cautious, which sort of makes sense, and just like because investors have sort of maybe have been getting over their skis just a little bit, and that's why we're seeing some recalibrating happening here among market participants. Totally makes sense. But then, what does this mean as a last question in terms of actual portfolio allocation? As I'm understanding and reading you, it's not yet time to get an exposure like entirely to bonds or something like this, just because you want to hedge in for a sort of recession that might be around the corner. But like concretely speaking, how are you positioned
Yep.
then?
So how you're going to be positioned is going to vary by what type of investor you are, right? So if you're a really fast moving investor, sure, you can buy bonds, today. You can buy bonds today and you can hold. But the thing I think that is the really big question is the only reason to buy bonds over a multi-month, multi-quarter, multi-year period is if you want one of two things. Okay. It's either you think that the carry, so how much yield do I earn on the bond relative to the existing cash rate, is good. That's one reason. Like if the 10-year is at 10% and the cash rate is at 5%, I can get 5% carry for doing nothing. And I like that. That's one reason to buy a bond and note, right? It's a good reason to. Alternatively, I have to expect the yield to come down, right? So I expect the yield to come down. The major reason I'm going to expect the yield to come down is going to be because the Fed changes its policy. Now, the Fed is unlikely to ever change its policy very meaningfully unless there's a serious deterioration in growth. So I think that you can, if you're a trader, and we have strategies for professional investors that trade on a daily basis, you can buy bonds. But I think the main thing that we have to consider when it comes to bonds is, are we going into a situation where the Fed has to cut 4+ times? And right now, we don't think that that's the case. We think that if you're buying bonds right now, you're buying it as a tactical trade on a growth scale. You're not necessarily buying it on the basis of a cutting cycle recession. When it comes to stocks, I think that much like with bonds, right, what makes sense over here is it makes sense to pull back your exposure because you could have a situation where equities continue to fall. But at the same time, you have to recognize that, look, at the end of the day, the biggest event that you want to avoid for equities as a day-to-day, everyday investor is a very, very big drawdown caused by recession. So we think that it makes sense to be cautious, not have exposures on when it comes to equities. And if this all just resolves itself, you can easily accumulate and add back. We have, monthly easy to replicate, price the turnover once a month. Well, for the time being, we're avoiding both stocks and bonds, right? And I think that that's the way that we're going to approach this. I think the main thing to consider is that if these price moves reverse, right? Like imagine you just didn't look at markets for a month and you came back and these price moves completely reverse. Do we still think that it's likely that we're headed into a recession? The odds would probably be much lower. And so the way we're approaching this is that we don't think that we're headed into a recession, but we don't think, it's necessary that you have to go all in on risk because you don't think that there's a recession. There are plenty of reasons that markets can correct as they have recently without a recession. So just being careful and avoiding those drawdowns is the way that we're approaching it.
I see. Great. Yeah, great advice. So, Aahan, I think we've gone over an hour. Thanks a lot for sharing all these insights with us, like a true masterclass on investing and like interpreting the market. So thanks a lot. I surely learned a lot. I have to re-listen to it myself to just sort of dissected everything that you said. So just thanks a lot. And maybe just one last question that we ask to everyone that we have on our show. Is there any other high signal person that we should invite to this show that could sort of teach us on similar things that you taught us about today?
Sure. Give me a sec. I have a long list, so I have to think about who would be my top one. That's a hard call. I'm not going to give you my top one, but I'm going to give you somebody who's been on point a lot, and generally been a big fan of the work. I would say probably, if you can, have Andy Constant on. Great experience, great guy, extremely smart. I really enjoy the stuff he does, and
Yeah, exactly. Yeah, he's been floating around on X as well, and with a lot of good takes, and especially some crypto guys love him as well because he's just really straightforward, which is great. Cool. Yeah, thanks a lot for doing this, and I think have a great day, and maybe talk to you some other time again.
for sure, anytime. Thanks so much.